Accrued revenue is an accounting term for money your business has earned for which you have not been paid yet and you have not invoiced your customer for yet. Let's explore an example of how to use accrued revenue to better understand the term. So imagine you are the accountant for a consulting firm and it's time to finalize the accounts for January. When reviewing the draft income statement, you can see that nothing has been included in consulting revenue, so it looks like the business has paid a lot of expenses during January but hasn't earned any revenue. But what actually happened in January is that all of the business's consultants worked on a big project that won't be invoiced until February. So because no invoices were created in the accounting system in January for any consulting work done, no earnings were posted to the consulting revenue account for that month. As the accountant, you know that this is not a problem, and all you need to do is accrue some revenue by posting an adjusting journal into the accounting system. To work out how much revenue to accrue for January, you speak to the manager in charge of the consultants. Together, you work out how many billable hours each of your consultants have done in the month, and you multiply it by their charge-out rates to calculate the amount of revenue each staff member has generated. All the individual amounts add up to $100,000, which is the total amount of revenue you need to accrue for January. You then post a manual journal in the accounting system on the 31st of January, being the last day of the month, that looks like this: a $100,000 debit to accrued revenue and a $100,000 credit to consulting revenue. After posting the journal, you review January's income statement again to see that $100,000 of consulting revenue has now been included. The income statement now represents the true picture of how the business performed in January, with $100,000 of revenue generated against $90,000 of expenses, leaving a profit of $10,000. You then review your balance sheet as at 31st of January. Because the accrued revenue account represents revenue you have earned but not yet received, it sits in the current assets section of the balance sheet along with accounts receivable. Just like the income statement, the balance sheet now represents the true picture of the business at the end of January. The business has no outstanding invoices in the accounting system, so accounts receivable is nil, while accrued revenue shows $100,000 of revenue earned but not yet received, for which no invoices have been created. After reviewing your income statement and balance sheet, you conclude that you have successfully added $100,000 of accrued revenue to the accounts for January. Let's take a look now at what will happen to the accounts in February. Sometime in February, once the project is finished, an invoice of $180,000 will be created on the accounting system to charge the client for all of the consulting work done on the project over the last few months. But when the invoice is created, the accounting system will automatically post $180,000 to consulting revenue in February's income statement and post $180,000 to accounts receivable on February's balance sheet. This will make it look like the business earned $100,000 of revenue in January and $180,000 of revenue in February, which is $280,000 in total. This, of course, is incorrect, as the total amount of revenue generated over the last 2 months should only be $180,000. Once again, you know this isn't a problem, and all you need to do is post a journal in February to reverse the journal posted in January. This can be done in one of two ways. In some accounting systems, you can set up adjusting journals so that they automatically reverse the following period. This saves you from having to do it manually. But if your system doesn't allow for this, or you just want to do it yourself, you need to manually post the reversing journal. Either way, the reversing journal is going to be the exact opposite to the original journal, except that it is going to be posted in February and not in January, and it will look like this: a debit to consulting revenue of $100,000 and a credit to accrued revenue of $100,000. At this stage, it's worth pointing out that although the reversing journal was posted on the first day of February, It could have been posted on any day of the month. That said, it's customary to post adjusting journals on either the first day or the last day of the period. After the adjusting journal has been posted and the invoice has been created, the income statement will correctly show that over the 2 months, the business has earned $180,000 of consulting revenue. And February's balance sheet correctly shows that there is nothing in accrued revenue, because there is no longer any uninvoiced revenue on the system. Instead, the business is owed an unpaid invoice of $180,000, which is why that amount is now in accounts receivable. Now let's see what happens to the accounts in March when the client pays their invoice. When the invoice is paid, your accounting system will automatically debit cash at bank by $180,000 and credit accounts receivable for $180,000. Your income statement will still show that the business earned $100,000 of revenue in January and $80,000 of revenue in February. This is an accurate representation of how the business performed during those months. As for the March balance sheet, it will show that the business is not owed any money from either accrued revenue or accounts receivable, and it will show that the entire $180,000 paid by the customer has been added to cash at bank. So that's how you can use accrued revenue to ensure that the income statement for your business shows the correct amount of revenue earned each period, rather than how much money it has invoiced or how much cash it has received from clients. And this helps to ensure that your financial statements accurately represent the true picture of how your business is performing each period.